questions in a detailed manner. Now, to structure for the day's proceedings, from the private equity and sectors in focus panels in the pre-lunch sessions to the venture capital panel in the afternoon, we'll focus on specific issues relating to each segment of the private equity funding ecosystem and have plenty of time for interactions both during the panel discussions and the networking breaks in between. With that, to set the stage for the panels to follow, I would like to call upon our, call on stage our first panelist, first panel speakers. I would request Arnav Dayal, partner Trilegal, to come on stage. Deepak Malhotra, managing director CDPQ. Nidhi Chawla, head fund of funds Kotak alternate assets. Saurabh Chatterjee, director ChrysCapital, and we will shortly have Ruchira Shukla, head of South Asia Disruptive Technologies, IFC, joining us. I would also now like to welcome to the podium our founder, Arun Natarajan, who will be presenting a short presentation on what the data says on the state of private equity venture capital in the first 9 months of 2023.
Thank you, Sonal, and welcome all again. And this is a short presentation to set the stage for the private equity panel. And let me just kick it off with a quick note on what we do for bread and butter at Venture Intelligence. So we are a data services company tracking private companies, their financials, transactions, valuations. That's been something that we've been doing since 1998 and more formally in 2002. So we are the kind of longest track record in this space as such. So we have a private equity deals database. We have a private company financial database, 50 to 60,000 companies and tracking, adding 100 companies pretty much every day. We have an M&A database, tracking inbound, outbound, domestic, all of them. Private equity and real estate. And, through the course of the day, we'll give you some screenshots of, what's to come, from all these databases as well. So let me move forward. First 9 months, 2023, no surprises. We are tracking a bit on the lower side. This is a quarter-on-quarter picture. This latest quarter, again, we saw a bit of a dip, $6 billion, which is kind of clearly, as you can see, we are trending lower. Is not all doom and gloom, definitely. So if you look at, kind of the annual picture, we are, again, no surprises, trending lower. But as I go forward, you will see some glimmer of hope that, there is a bounce back. Again, we are talking about, for the first 9 months, about $24 billion. So that is not comparing, obviously, any favorably towards, kind of 22, forget about 21. We are kind of, at best looking at catching up the 2018 figures, right? So this is overall private equity, venture included. So we all know the story, of the unicorns, 21, we had to fit in 4 bars to capture, the number of 44 unicorns on that slide. 22, despite so-called winter setting and all that, still had, 21 unicorns, make a mark. And we have one company, Zepto, making an entry into this table in 23, right? So that story, is kind of clearly not tracking well. So if you look at this, from a mega deals perspective, that tends to kind of take a significant share of the pie each year. And this year, again, it's been no different. In fact, first 9 months, 75% of the deals, mega deals we talk about, 100 million plus, transactions, they accounted for quite a bit. Which are these? Here are some examples. We know about the Manipal hospitals, that is the $2 billion plus deal. And we have ChrysCapital represented on the stage. A phenomenal deal in terms of HDFC Credila, very, very unique transaction. We will let them talk about it. Of course, Reliance Retail, was part of that, recovery in 2000, the kind of 2020, we had such a bad year until Reliance stepped in, both Jio as well as Reliance Retail, and kind of raised this $9 billion and pretty much brought the mojo back into the ecosystem, right? So we are seeing Reliance Retail back in action again, not just Qatar investment, we've seen subsequently KKR and others invest in the same company. So that is, clearly up there. And a whole bunch of healthcare transactions, infrastructure transactions, have kind of, we again have CDPQ available here to talk about infra investments. They are clearly, kind of kick-starting, the bounce back, as we see it, but the panel obviously will know better. Healthcare, infrastructure, all tracking, far better, towards the recent months. Industries, like I said, the whole digital-driven, upswing between 2020 and 2021, as you can see the brown bar there, clearly the share of the pie of IT and ITES is coming down, and it's kind of settled to the 33% that we used to see, pre-2019. We kind of reverted to that. Let's see how we track going forward as well. So what has taken up, this thing clearly, as you can see, healthcare is doing far better. Financial services has been the kind of, between healthcare and BFSI, typically the second and third verticals that step in, but we are seeing increasing investments in manufacturing. Retail exception is Reliance predominantly. Right, so in terms of stages, that's something that we will tackle venture part in the afternoon, but clearly venture is tracking lower. Typically what we've seen, things tend to cascade from the public markets to late stage. So in 2022, we saw venture still being a bit vibrant, but now no longer the case. So probably the cycle will turn again. We will have the panelists talk a bit more about that, how things move from late stage to kind of, growth, and then the cycle probably will turn and catch up with the early stage, probably a bit later. So in terms of fundraising, so we've seen a lot of dry powder concurrent with, the kind of low ebb in terms of investments. A lot of funds, including India dedicated funds, have raised substantial capital. So clearly, it's a confidence issue. There is enough dry powder or capital that's been raised but uninvested in the system. So here is an example of the kind of, fundraise that has happened, in the recent years, and it's not tracking badly at all compared to the investment graph that you just saw, right? So some of the examples, venture funds also have, quite a bit of dry powder with them. Here are some, and again, we have Kotak represented on stage here. They've raised a pretty large fund, and so like I said, so has multiples and other venture funds as well, and growth stage funds. Creages is a good example from the recent months. So how are we doing in terms of exits? That's key for these folks to kind of release that capital back to their LPs and, give them that confidence. So exits have not been tracking as badly as the investments, right? So things are actually, not bad, except the 2021 peak. Frankly, 21 is something that we should take out as an anomaly. Again, most of the panel should agree on that. It's not looking bad at all if you look at it historically in terms of exits. So where are the exits coming from? Public markets have been supporting very well, right? So we all know that the kind of IPOs that are lined up, and that is already reflected in the first 9 months in terms of the exit. So some examples, Flipkart, the big one of 2018, Tiger and Axel, just completed the exit. They kind of retained a bit of equity, so that is the largest deal. Manipal Hospitals, a secondary transaction, change of hands between TPG, from their earlier fund to then, others exiting to Temasek. And then we had Baring Asia exit substantially through the public markets, and we've seen people exiting, from other listed companies as well. So PE-backed IPOs, like I said, they've been tracking well, and, relatively, of course, and not to consider 21. And, here are some examples. Again, Chris is represented on stage. They have Mankind Pharma. We saw RR Kabel, and then Concord Biotech, Samhi Hotels, all of them, kind of making a mark on the public market. So I will leave it here with an optimistic note on, how the public markets have been tracking well, and hopefully a trickle down will happen, to investments as well. Thank you very much. I will now have an introduction of the moderator and then open over to the panel. Thank you so much.
Thank you, Arun. Now I would like to introduce the moderator of our first panel, who is Arnav Dayal, partner Trilegal. Arnav Dayal is a partner in the corporate practice at Trilegal with a focus on merger and acquisitions, joint ventures, and private equity investments. Arnav has represented various Indian and multinational corporations and institutions on a range of corporate commercial transactions, including strategic acquisition, joint ventures, and like I mentioned, private equity investments. Arnav regularly advises on structuring investments and strategic issues in cross-border joint ventures. He has significant experience in transactions in diversified sectors, including renewable energy and infrastructure, telecommunications, information technology, e-commerce, retail, insurance, and defense. Now I would request the panel to start.
Thank you so much for that kind introduction, and thank you everyone for coming for today's session. I think we have a very interesting agenda which is quite relevant in today's environment. Specifically for this session, we are focusing on private equity in the new normal. With the pandemic largely behind us, I think some of the impact of the pandemic as well as the consequential policies adopted during that phase continue to linger, and we are witnessing historic levels of global inflation, high interest rates, and high cost of capital. Coupled with this, there are rising geopolitical tensions, protectionist policies across the globe, as well as major elections coming up in at least two big economies of the world. So it's perhaps an ideal time for us to be looking back and seeing what the lessons learned are from the last few years, where we stand today, and what the outlook is for the future. And to talk through these aspects, we have a very interesting and a very impressive panel with individuals who are right in the thick of the action. And I personally am really looking forward to hearing everyone's thoughts. So before we start with the discussion, perhaps we can do a quick round of introductions of our fellow panelists as well as their organizations. Deepak, perhaps we can start with you.
Yeah, hi. Thank you, Arnav. Hi, good morning, everyone. My name is Deepak Malhotra. I'm Managing Director for CDPQ's infra investments in India. CDPQ is Canada's second largest pension fund. We manage around $400 billion worth of investments globally. We came to India in 2016. Since 2016, CDPQ has invested $8 billion in the country across various asset classes. Thank you.
Good morning, everyone. My name is Nidhi Chawla. I'm from Kotak Alternate Assets. I'm Director of Private Equity for Kotak Alternate Assets. A little bit about Kotak Alternates. It's about $9 billion of assets under management across various verticals: real estate, strategic situation funds, data center fund, infrastructure, as well as private equity. I represent the private equity part, and there also we have multiple strategies running. I head the fund of funds piece as well as the late stage investing piece. Thank you.
Hello, everyone. Saurabh Chatterjee. I'm a director at ChrysCapital, where I lead the fundraising business. And I'm also on the investment committee, so I come from the investment background as well. ChrysCapital, we were established in 1999, so we've been investing in India for almost a quarter of a century now. We've raised about $5 billion across 9 private equity funds, invested more than $4 billion across 100 investments, and realized $6.5 billion from almost 80 exits, actually. Closed out our first 5 funds on time, so we're investing out of, we have 4 active funds, the last fund being Fund 9, which we raised about 18 months ago at about 1.3 billion. We invest in 4 or 5 sectors: business services, financial services, healthcare, consumer, and new economy. And happy to be here.
Thank you, everyone. So to get started, I think the first theme I'd like to talk about is really where we are today. And perhaps, Nidhi, to start with you, you talked about your experience with the fund of funds, and I'm curious to know what sort of differences there have been when it comes to your experience from a funds of funds perspective as opposed to being a direct investor. And in the past couple of years, what are the sort of trends that you have witnessed which have played out the way you would have expected, and what has not really gone as per plan? And I know that, when we were speaking just before, you mentioned it was a roller coaster ride, so it would be interesting to hear.
No, I think I'm very curious. I wasn't in the conference last year, and I'm taking a bet that I think the mood today is much more optimistic than last year. Things are looking much brighter. Ours is the late stage technology fund is a 2021 vintage fund, and to be honest, when we started, we had just about invested 30% of the capital, and we realized that the market is just too hot. We didn't invest anything for 1 year, and it was a time when we really thought that should we even continue the fund, what's going to happen. And then market has kind of turned around. There is a lot of sanity prevailing in. And from a fund of funds vantage point, we are seeing very similar experience being seen by other private equity funds as well as venture capital. Because of the valuations coming down, the razor-sharp focus on the profitability by companies, as well as companies which are ready to go to the market, are now pricing and their IPOs in such a way that there is enough money left on the table. And the domestic institutions, the mutual funds, insurance outfits, etc., are also making sure that the pricing is not obnoxious. May 23 onwards, especially Mankind Pharma, a ChrysCapital company, had a stellar debut on the public markets, and since then, the markets have kind of bounced back. And and the story has changed completely. We are, to be honest, getting a little scared on the small and mid-cap side. It is definitely getting hot out there. And again, maybe some cautious thinking needs to be reinforced again. Having said that, we're very, very, very happy with the way portfolio companies, not just ours, but of others as well, is performing. And I think this entire roller coaster ride, which I mentioned, has actually knocked a lot of, sense in kind of talking about profitability and making it the mainstay rather than chasing a valuation. And that's what we are very, very happy about.
All right, thank you. Before we move on, I think perhaps Ruchira has just joined us, and the rest of the panelists have already introduced themselves, so perhaps Ruchira.
Thank you so much, and apologies for joining late. I am responsible for IFC's disruptive technology business in South Asia. For those who might not know, IFC is the private sector arm of the World Bank Group, and we invest across emerging markets and have been doing so for the last 6 decades. When I say I'm responsible for disruptive tech, what that means is early stage direct equity investing in technology-led startups, as well as VC funds. So those are my 2 areas of focus. We tend to be under 20% in the stakes we take and can invest anywhere between $5 million to about $20 million as the first check. The larger part of the business is direct. In South Asia, which I'm responsible for, we've done 19 direct investments and 9 VC funds.
Thanks, Ruchira. And while you have the mic, perhaps I can direct my next question to you. We are discussing, how the last few years have panned out and where we stand today. And particularly for the tech industry, I guess it's been, as we were discussing, a roller coaster ride, because there was a boom during the pandemic, and now there's a so-called funding winter. So it will be interesting to hear your experience of how the last few years have played out.
So these kind of ups and downs that you talk about are the kind of cyclical resets that one should expect. And it's not alarming. It is what happens. It's how this industry runs. But I would take a longer term view when you think about how tech in India was in the early 2000s, when the first digital age companies were created, to where it is today in 2023. In the last 20 years, the nature of business model innovation has shifted dramatically. India went from doing very basic horizontal and vertical e-commerce to now very unique problems for the country and problems for the world that can be solved using technology. So fundamentally, the kind of innovation coming out of the country for the world has shifted to a level of higher sophistication. The entrepreneurs of this country have evolved to be more mature, to be building more lasting, profitable businesses. So I look at the longer term trend, and I look at the ups and downs that you're talking about as cyclical blips, which will happen, and they are expected to happen. I think now is a great time for investments to be made, because we are in an environment where founders' expectations are coming down on valuation, investor-friendly terms are being put into place. So I think the investments we make now are going to be set for success.
Saurabh, moving to some of the other sectors, and I think ChrysCap has done some big-ticket acquisitions in this year in diversified sectors. I think Nidhi was talking about having a razor-sharp focus and a change in approach in doing deals. What has been your experience in some of the other sectors and your approach to evaluating deals in those sectors?
So I don't think our approach has changed very much. I think our approach has been the same as it has been over the last, almost 10, 15 years really, which is investing in high ROC companies run by high quality entrepreneurs where we can be agents of change. I think the agents of change part is what has sort of really developed over the last few years, because earlier, 10 years ago, the overall global economy was growing faster, India was growing faster. So promoters and entrepreneurs could really focus on sort of revenue growth and top line growth, really, and that would deliver the 20-25% compounded return. Now, global economy is slower, Indian economy is slower, so instead of that 20-25% revenue growth, you're seeing sort of 15% growth. And the companies we are looking at have also gotten bigger. So when you're looking at a $100 million revenue company, that can grow faster. And Mankind would be a great example, right? We invested in Mankind twice. Once it was growing at 25%. The next time when we invested, it's still growing fast, but growing at 15%, as the company's just gotten bigger. So in that sense, now you have to focus on cost optimization, process excellence, professionalizing the company from a family-run company to a more professional business. And that is kind of what we're focusing on. So it's gone from just helping the company on revenue growth to helping the company on cost optimization, things like that. And Indian promoters, entrepreneurs in general, have been great at sort of revenue growth. They haven't been great at optimizing cost, process, things like that. And that's when they realize, look, we can't do it all ourselves. We are happy to work with investors who have the ability here to drive change on this front, and they're willing to listen to us. They're willing to bring on folks like McKinsey, Bain, BCG, who are also smart. They are not charging sort of flat fee upfront. They're working on contingent fees. So we'll save you X million dollars in cost, and we'll take a portion of that. So that is something that is more palatable and amenable to the Indian promoter, where they don't want to pay the upfront cost, but if you deliver value for me, I'll give you a cut of that. So I think that really, that focus from just focusing on revenue growth to focusing on cost optimization as another lever of driving value, focusing on M&A, focusing on things like that, that is, I think, the change that we've seen over the past 5-6 years. And that also goes to some of the points that we made today already, is that helps you manage the higher valuations that you're seeing in the market. Because at the end of the day, look, we are an India-focused fund. We're not a pan-Asian fund. We've raised $1.3 billion fund, and we have to deploy it in India. Some of it can go to sort of US-based IT services firms, but the bulk is in India. And we have been active, right? We've done $150 million in HDFC Trilegal this year, $100 million in Lenskart, $100 million in GM Fodler. So you do see value, and there are higher price deals out there, but you have to find a way to get to that 20%, 25% return. And if that does not come through, if you cannot count on multiple expansion, then you've got to count on the business doing really well and the business getting more efficient, right? So that's what you have to focus on to sort of counter the high valuation market, which you are seeing now. And I'm on the fundraising side, so I meet a lot of global LPs all the time. Their concern also is high valuations. How do you address that? How do you deploy in this market? Their concern is also different because they look at India as being fundamentally more high valuation than any other market out there. There are reasons for that. India is fundamentally more high ROE market. It's a high growth market. So that just drives, the value of a brand in India is very strong. So on the consumer side, when you build a good brand, or any side, any business, when you build a good brand, that creates a much bigger moat around the business than it does in a lot of other economies in the world. So that's why India is a fundamentally high valuation market. But from our perspective, I think that's how you drive value, or that's how you get around the valuation part, is one, by going deep into your sector. So when we say valuations have increased, that's a very 30,000 foot level comment, right? There are many sectors, many subsectors. When you're looking at pharma, it's not just pharma, it's acute versus chronic. When you're looking at chronic, which therapeutic areas are doing well? Within therapeutic areas, which companies have molecules that can drive value? So you go 3-4 levels deep to find the right company that is still trading at a reasonable valuation, and then you focus on these value-added things that can change the trajectory of the company and be a little of a step change rather than a linear growth. So that's how sort of I would say, so coming back to sort of your question, we are looking at the fundamental lens hasn't changed, but I think what we're focusing more on is value addition to drive that.
Thanks, and that's a very interesting theme, and one which I'll like to touch upon, especially on the additional value which private equity investors can bring to portfolio companies beyond just, capital. So we'll touch upon that. But I think one trend from the legal perspective as an advisor, which I have sort of been noticing, and if it's consistent with your approach or your experience, but I think deals are tending to take a little longer because I think during the pandemic and even before that, for instance, when there was this whole e-commerce boom, everyone wanted to jump on the bandwagon, and irrespective of the valuations, irrespective of concerns, there were a lot of issues which were sort of just sidelined and not really looked into a lot of detail. Now I think there is a focus on bottoming out things to the last detail before making a call. So capital is being deployed, but perhaps selectively, and it's perhaps taking slightly longer after doing the rounds and seeing multiple targets and then picking on the right one. Deepak, just focusing on the infrastructure sector, and that's one which in India has been particularly hot for a while now. And as we were discussing, roads and renewable energy specifically have, picked up in a big way. And this is on the back of, historical issues that have plagued the sector, regulatory flip-flops, things like renegotiation of PPA tariffs, lack of credit-worthy counterparties, land acquisition issues. I think to a large extent, those issues are sort of have been dealt with, and the industry is fairly stable now, and therefore it's an attractive one for foreign investors, and especially long-term patient capital like yours. But what do you think are some of the other drivers that have led us to where we are today?
Okay, thanks, Arnav. So in the last few years, there's been a pretty long demand from investors who invest in the infra sector to the government that please come out with long-term plans for countries' infrastructure needs. And the reason why investors were raising this was, when we invest, we typically don't look to invest, let's say, and buy a single road asset or a single 100 megawatt renewable asset. Investors typically like to look to build businesses. And you can build businesses, you can invest long term only once you have visibility on what is going to come your way in next 4 years, 5 years, 10 years. So that was a long pending demand from the, at least investors who were investing in the infra sector. Fortunately, government listened to this. They prepared infrastructure's, Government of India's National Monetization Plan. They also came out with National Investment Pipeline in the infra space. And that gives a fair bit of visibility to the investors in terms of what is going to happen in the next 4 or 5 years in the sector itself. National Monetization Plan for Infrastructure, I think, spans or has identified assets worth $200 billion that needs to be monetized in the next 4 or 5 years. Similarly, on the greenfield assets, countries' need is of investments worth $3 trillion in the greenfield assets. Those assets have been earmarked, sectors have been identified. Obviously, it's going to take some time for those assets or projects to move and investments to come in, but it's a step in the right direction from the government's perspective. Some of the issues that you highlighted specifically in the road sector and the renewable sector in terms of changing tariff, renegotiation, yes, they were legacy issues. They used to happen, and that had kind of slowed down investment in the infrastructure from large investors. But again, I think government has been pretty proactive in terms of listening to the concerns raised by the investors. And they are trying to actively take on and try to solve these issues. For example, in the road space, the investors who invested in, let's say, early 2000s, most of them, they lost money very, very badly. Even the capital also got eroded. And the reason was, part of the reason was, those investors, they were trying to take all kind of risks. For example, they were taking even the risk on opening traffic in a greenfield road, right? No one knows how much traffic will turn up once the road is constructed. So when, as an investor, you take a risk that probably you are not in the position to quantify or assess, it's pretty likely that things are going to go wrong. Versus when you take a risk which is in your control. So now you see a lot of investments happening in the road sector. Again, not in the greenfield side because investors have lost money there, but at least on the brownfield assets where roads are operational for the last 2 years, 3 years, 4 years, and you have a lot of stable operating traffic data, especially in terms of base traffic. Now, what could go wrong from there once you know what your base traffic is? what could potentially go wrong is maybe your projections in terms of, how much traffic will increase year on year. Okay, you might have, taken in your base case a projection of 5%. It may turn out to be 4%. It may turn out to be 3.5%. But you're not going to lose your shirt, right? I think that realization has come in. And that's where you've seen success of a road monetization plan in the country, where NHAI, National Highway Authority of India, they have started monetizing these road assets. And with NHAI being a pretty stable concessioning authority, policies are pretty stable, concession agreements are robust, investors have got used to it. NHAI has a pretty strong track record in terms of dealing with the investors. You are seeing a lot of increased investments in the space. Similarly, on the renewable side as well, you go back 15 years, in 2000s when renewable investment started. Policies were not pretty stable. There were a lot of state concessions that were being come out. SECI, the regulator, which is now Government of India has put in, was not in place. And there were a lot of concerns that the investors were having in terms of renegotiation, etc. Now with SECI coming in as being the central concessioning authority on part of Government of India trying to organize these auctions, you've seen a lot of stability in the sector and therefore the investments. So the point that I'm trying to make is that investors would be keen to invest. India offers to them a pretty lucrative opportunity and a size and a scale that probably is not available anywhere in the world, at least not in the Asian geographies. So the investors who are going to expand to Asian markets, India offers to them a very attractive proposition in terms of investments. What they're looking at is pretty much stable policies, support from government, etc. And the need of the country is pretty huge in terms of asset allocation, asset build-up. So investments will happen as long as regulatory framework is strong and there are right opportunities.
Thanks, Deepak. Turning our attention to the future outlook, Ruchira, from your perspective, when it comes to disruptive technologies, what is your outlook for the next year or so? And is there a change in focus or the types of investments you're looking at? And what sort of roadblocks or what are the signals that really you need to be watched out for? You talked about there being a cycle, and perhaps we are at the bottom of that cycle right now, so things can only look up from here. Is that so, or is there other things which could sort of derail the story?
So I think we are in a very good position. And last week I was in Copenhagen for the GIN conference, and before that at Super Returns, and all eyes are on India. And I emphasize that all eyes are on India because various investors have pulled out of China. They realize that while across Southeast Asia there are certain pockets of opportunity, a lot of those assets tend to have even more froth than you see in India. So there is more of an asset scarcity premium on assets coming out of Indonesia, Vietnam, Thailand, because there are very few and far between opportunities. Whereas in India, there is a large market, lots of innovation, 5,000 startups being created every year. There's a lot more to be done and a lot more opportunity for investors to chase. So I think all eyes are on India to find those innovations that set apart from the others. I think we are in a fabulous moment in time because, like you said, we are at that bottom where not only are we going to be able to find good companies, but we are also going to be able to price them right. We're going to have terms that will be investor friendly, and so the investments we make today will be well positioned to deliver outsized returns. From a focus perspective, we are very keen to see the next level of innovation in health tech, because if you think about what we've seen thus far, they are mostly the digital integrated models like the 1MG, the PharmEasy, etc. We haven't seen much in terms of medtech innovation. Genomics is also just about scratching the surface, so we expect to see better and more path-breaking innovations in the health tech space. So we're keeping our eyes out for that. The other area where we see a lot of opportunity is climate tech. The low-hanging fruit in climate tech was around renewable energy, electric mobility, but we are now beginning to see innovations on preserving food supply chains and food security, soil health, smarter agriculture. So there's a lot more innovative stuff beyond the low-hanging fruit that we're beginning to see. So keeping our eyes out for both health tech, climate tech. And the third area would be SaaS. So India has seen a lot of breakout SaaS companies that are winning globally. And I think there also we're just about scratching the surface. There will be a lot more innovation. So for IFC's disruptive tech team, those are the areas of focus.
Yeah, and I think disruptive tech and the energy transition are sort of, and you talked about some of the clean tech sort of ventures. So both of these things sort of go hand in hand. And Deepak, India has lofty targets. I think 500 gigawatts by 2030 of renewable energy. All of that requires a whole lot of capital, which in these times could prove to be challenging. But there are also other indicators which show causes for concern, because there are some policy flip-flops in other jurisdictions. UK, for instance, is sort of slowing down on its energy transition aspirations. Some of the oil and gas majors also, who had made noises about energy transitions, are seemingly having a rethink. Do you think that there are issues which need to be addressed, or if we, at least from an India perspective, we are on the right track to meet the targets that we have set?
I think, Arnav, in terms of the development that has taken place and the investments that have taken place on the renewable side, I think India is pretty much on track. Last 10 years, as we discussed, a lot of investors have come in and set up their shops in the country. They've started investing. Just maybe go back 5-7 years, and you see in the infra space, there were hardly, I think, a handful of the investors who were coming in and investing in the country. And today you have likes of, all Canadian investors, CDPQ, CPPIB, OTPP, OMERS, Brookfield. You have likes of, hardcore private equity players who used to only invest in the private equity sector, like, Macquarie. You have KKR, who recently started investing in the infrastructure space, right? And all of them are very actively investing into not only broader infra, but the renewable sector as well. Given that all these large institutions, they have their own internal targets in terms of, energy transition and how much capital should go into the green space. So I don't think the issue as far as meeting these targets is the lack of capital. That definitely is not the case, given, as we discussed a while back, India presents the opportunity and scale that probably no other geography presents currently to these investors. The issue that probably could become a stumbling block in meeting these targets is, let's say, where do you go and set up these 500 gigawatts of plant, right? Land availability. Do you have so much of land to be able to set up these solar panels? Do you have your environment clearance and forest clearances and all those kind of clearances in place, and how much time does it take for these clearances to come from government in order to be able to set up these plants? So I think these are going to be the larger challenges rather than just the capital per se. But given the fact that the investors have become quite comfortable with the way these concession frameworks work, with the track record of payment coming from SECI, which is pretty robust, unlike some of the state discoms, where payment also becomes pretty erratic. I think investors are becoming more and more comfortable in investing in this space. So I think this target is achievable. It is ambitious, absolutely no doubt. 500 gigawatts in the next 5 or 7 years is not easy, but something that can definitely be aspired to. In terms of targets for investments in energy transition space, I think all investors are pretty keen. The issue is, how do you actually do the energy transition? Is just setting up greenfield solar projects or wind projects or hydro projects, are they actually called the real energy transition? Or energy transition should be something like, you go and support the steel company, which is a huge guzzler of power, and using diesel power, using generators, using thermal power, and you actually do energy transition for them. And let them consume green energy rather than going through loads of coal-based thermal plants. Similarly, cement sector, right? You do something there in that space and do some kind of energy transition. That to me is the real energy transition play. The country offers that. There are a lot of large steel manufacturers, cement manufacturers who are, I think, capable of moving in that direction. The issue is moving on to technologies like green hydrogen, etc. Are they commercially viable today for investors to set up investments in these space, and even for these developers, are these technologies even commercially viable? But again, if you compare solar the way it has moved in the last 10 years. I think we were pretty much in the same space today where solar was 10 years back, where we all were debating and thinking whether solar will ever become viable. Right? But 10 years down the line, the technology has changed. Today, solar power or renewable power is actually at par or actually lower than the thermal power. Similarly, I think there will be some time before these technologies, they become viable. But I'm pretty sure that, there will be a lot of shift and movement towards energy transition in the real world as well.
Sort of focusing on some of the other sectors, and I think pharma is one which ChrysCapital has sort of looked at and been bullish on. Financial services is another one, I think, and like I mentioned, you've placed bets on those two sectors recently as well. What is your outlook for those sectors, and are there any other sectors which you think which beyond technology and infrastructure are sort of being missed out in the story?
So pharma has been a focus for us. Pharma and financial services have been focuses for us since almost day one. We actually deprioritized lending financial services in Fund 8, which was invested during COVID, and put a lot of that capital into new economy. Because when we started investing Fund 8, that was early 2020, COVID hit, we realized, look, lending financial services is going to take a huge hit because, lending moratorium, lockdown, etc., people won't be able to pay back loans, they don't need to pay back loans. So we decided, look, let's not do lending financial services, and where else can we put that capital? And that actually went into new economy for us. So 20% of the fund that has always been historically invested into financial services, that went into new economy in Fund 8, and that's when we really started investing in new economy. And our lens in new economy is honestly very similar to the lens we use for evaluating the standard, quote unquote, the standard sectors, which is, it has to be high growth, high quality entrepreneur, focused on profitable growth, not on cash burn. It has to be a company which has strong unit economics, which there is no risk of the business going from 1 to 0, there is no business risk. And liquidity is around the corner. So the company will go public or may go public in the next sort of 2 or 3 years. And if you look at the companies that we've invested in, that has sort of, those have fit that mold. So Dream11, FirstCry, ExpressBees. We don't invest in winner-take-all segments or winner-take-all segments of the market. Or if it is a winner-take-all, the company we invest in has to be the winner that is taken on, right? Like something like Dream11. Now the risk we take when we invest in new economy is we're not taking business risk because the companies are already large, profitable market leaders. But we are taking risk is a valuation risk. So when you invest in a company like Dream Sports or Lenskart or FirstCry, large market, growing market leaders, profitable, about to go public, you're not getting a deal in those companies, right? They're like, if you don't like this valuation, I'll take one of the next 10 guys behind you. So I think there, the risk you're taking is valuation risk. And there you have to, be comfortable that, look, if we're paying up for this company, do they have what it takes to keep up that revenue growth, improve on profitability, keep focusing on profitable growth and not on putting dots on a map, which is the problem with the sector, right? And if it sort of ticks those boxes, then we go ahead and invest. And also what we try to do is, we try to, when I said we try to be agents of change and add value here, because we're taking small stakes, right? You're 3, 4, 5% stakes in a Lenskart or a Dream Sports, you can't get on the board. And especially because the board is already stacked with people from when they were much smaller companies, people from the VC side. But what we can do is, look, the VC people who are on your board, they bring a different lens, right? They were really helping you scale and professionalize and grow the company when you were very small. We are a different type of investor. We're a late-stage investor, and even if you're not on the board, we can help you with things that maybe the VC firms are not set up to help you with. So once again, the cost optimization, and for a company like Dream Sports, Lenskart, etc., helping them go public. Like we've taken, Mankind went public. We've taken 12 companies public, more than any other PE firm in India. There are 7 or 8 companies in our portfolio that will go public. Some will be, very large IPOs like Hero FinCorp, which will go public likely sometime next year. And for all these companies, the Dream Sports, FirstCry, etc., their ambition is to be public, right? So we can tell them, look, we can help you go public. We know all the things that need to be done, how to, augment your board, set up the internal processes, financial systems, management, how to actually run the IPO process itself. It's a non-trivial process, right? So we can help them on those angles, and that's how we get access to those deals in the first place. And how we can use, we're almost usually never the highest bidder. if a deal, the clearing price of a deal is 100, we're always sort of 95 or 96. But the goal is to get that call back from the entrepreneur saying that, can you come to 98 or 99? Even if you can't come to 100, because we feel that you bring a differentiated skill set and differentiated value add from the other people out there. And typically we manage to get that call back. It's not always that it happens, but we typically manage to get that call back, and that's sort of how we win these very competitive new economy deals. So I think new economy is something that we're excited about. And then business services as well. So business services, which is really IT services. We sort of really were the first Indian private equity firm to invest in IT services firms that were not based in, that are not Indian companies. So companies that are based in the US or based in Europe, and really exploiting that US-India corridor. We've had some landmark exits there. Infogain, which we sold to Apex for $900 million, Liquid Hub, which we sold to Capgemini for $500 million. And we continue to be very active there. And that's, we've got a very sort of, at this point in time, tested playbook where you buy these companies, you do accretive bolt-on acquisitions, you help them increase their share in digital, help sharpen their go-to-market, and then since it's an LBO, you get that leverage benefit as well. Since they are not Indian companies, you can actually put debt on the opco, on the company's balance sheet, and that leverage drives meaningful returns as well. So that's something that we're focused on as well. And that also from an LP's perspective, we are not an India-focused private equity firm anymore. About 70 to 80% of the portfolio is focused on sectors that are completely devoted to India, say consumer, pharma. Pharma also has an export component, but consumer financial services are completely Indian. And then IT services actually completely not Indian. So we actually, currently we have the flexibility from our LPs to invest in IT services companies which have nothing to do with India. So they may have a back office in India or may have a delivery center in India, but may not. So in that sense, we are also positioning ourselves as a, India plus US private equity firm, where 20% of the fund is actually invested in US companies. So I would say, in addition to pharma and financial services, IT services and new economy are two core sectors for us now.
Thanks, Saurabh. Nidhi, I think there is some bit of a dichotomy here because we are talking about funding winter for a number of startups, but as Ruchira was pointing out, India is the place to be. And there's a lot of diversion of capital from other jurisdictions coming into India. From your perspective, raising a fund in these times, what sort of themes are you looking at, and what would be the change in approach, or what sort of sectors would you be focusing on, keeping all of that in mind?
So, actually I concur with Ruchira. All the conferences we've been part of, talking to a lot of global institutions, Kotak Alts is almost 90% funded by, global institutions. All eyes are on India, and the the LP pool will only expand. The interesting thing is that I think it's now almost 3 decades of VC and PE journey of India, and we have come a long way. We have funds of different variety, right, from VC to distressed fund, buyout funds, credit funds. Then you have funds who have increased their size year after year. Funds hitting $1 billion, homegrown GPs hitting $1 billion marks, and also, those funds who have traditionally only raised outside are looking to raise Indian capital, and funds who have only raised in India are now, looking to raise outside capital, and that scene has completely changed. Also, India is now becoming a great source of return for various investors outside as well as within India also. And that is the reason why, of course, there are several sectors which we are very focused on, which we really like, and we think those funds focused over there can do tremendously well. Financial services is an evergreen sector. And you just have to pick the right subsector, whether it is MSME, NBFCs. Today, affordable housing, I think, is a great opportunity within NBFCs. Then we have, wealth management, insurance. I think insurance being so under-penetrated, that's a very big subsector within financial services. Pharma and life sciences. Now, there's one wave of generics which is done. The new wave is going to be the innovation in life sciences, as Ruchira pointed out, the genomics, the delivery of healthcare, the medtech devices, cardiac stents, kneecap implants, and so on and so forth, and them getting manufactured in India. And so another sector we are very excited about is manufacturing. I think that is something which is changing the game for India, the entire China Plus One strategy, friend-shoring, near-shoring, getting all those, Apple getting manufacturing done over here. I think the entire PLI scheme, which is being supportive of it, I think all the ducks are lined right now, and it's a Goldilocks zone. It's a great time for India, and some sectors are going to do really well, and we think that's if the fundraisers are aligned in that manner, it can definitely see a good start.
Just I agree with my panelists that every sort of super return, ABCJ, wherever you go, everyone's sort of excited about India, right? But I think one thing we tell our LPs is don't invest in India because you think the macro is good. Because the macro is good now, but if you're investing in a 10-year fund, there will be a couple of cycles. So the macro is good now, it may not be good by the time you write your first check for the fund. And it definitely will not stay at this stage, at this sort of level for the 10-year life of the fund. So, and also you have to think about it long term, right? If you're telling people invest in India because macro is good, the next time you go out to raise your fund, macro might not be good. So what are you going to tell them? Don't invest in India now? So I think our point that we tell LPs is don't invest in India because of macro, because you think the macro is good, because it won't be good for the entire 10-year life of the fund. Invest in India if you think we have the fundamental systems put in place now that will drive long-term growth in the next 15, 20 years. Yeah. And then we try to paint the picture of, look, the physical infrastructure, like we talked about, is now at a stage, and we're executing at a stage that has not been seen in India ever. We have the digital infrastructure with the India stack and UPI and Aadhaar and all those things that are driving fundamental change. So with that physical infrastructure and the digital infrastructure, I think now India is where China was 20 years ago. Right? We're at the cusp of a 2-decade growth run. And will there be ups and downs? Sure, but it'll be ups and downs with the ultimate trend line pointing upwards. So if as an LP you think that is true, then invest in India. And also I think at the end of the day, private equity and VC firms were not macro investors. At least PE firms are not macro investors, you're micro investors. Our job is to deliver a certain level of returns for our LPs no matter what's happening on the macro side. And India is a $3 trillion market. We are at ChrysCapital, which is the biggest India-focused private equity fund. We're investing $500-600 million a year. $3 trillion market, 3 or 4 deals, $500-600 million. Are you telling me we can't find good deals that will deliver a certain level of returns no matter what is happening on the macro, given how little we're investing in the overall scope of the market? Of course you can. So I think first, we are micro-level investors, not macro. And secondly, you can't count on macro to drive the story always. So have we put in the fundamental enablers that will drive long-term growth? Yes. So.
No, that's a very interesting point, because I know there's a lot of talk about manufacturing, China Plus One. I think there are a few things which we do need to be concerned about there as well, because not everything that was in China is being diverted towards India. There are other jurisdictions, Vietnam, Thailand, who are getting a lion's share of that. And while, of course, the PLI schemes have been very helpful in sort of invigorating the sector, the question is whether the fundamentals are being targeted, really, because what PLI is essentially doing is providing SOPs to a few entities within the sector as opposed to incentivizing the entire sector. So I think perhaps a long-term approach would be to look at the infrastructure, focus on things like R&D and technology transfer, so that the capabilities that India sort of develops are not available in other jurisdictions. I think we are doing a lot of that as well, and we're on the right track, but perhaps there is more work to be done.
I think, just to add on to this point, see, even in China, while China is almost 80% provider of solar panels and all the raw materials that go behind solar panel. There is that entire cycle of production, right from converting sand to that wafer which goes into the solar panel, and they hold almost 80%. It's a very capex intensive exercise, and it started because the government was behind it, and government gave a lot of SOPs. And that is what Indian government is trying to do. PLI might be just a drop in the ocean, but it is pushing the entrepreneurs to think in the right direction and realize that, you know, there is a large opportunity here to manufacture here. It could only be assembly. From assembly, you move on to the technology transfer, you start doing it within India. Earlier, we were only making those panels. Now we are actually we are now one step before making the panel. So the more and more backward integration we do, which requires a lot of capex, and that's what government is supporting. And that's why I think finding the right company, like for example, we have a company in our portfolio, it is India's largest cardiac stents manufacturer, and it is the third largest supplier for Europe. And it is at par with an Abbott. So I think, and that's cardiac stents, that something goes in your body. So we're talking about hardcore technology. And similar things we are seeing in a lot of cutting edge innovation happening in healthcare. And remember, healthcare technology development is also, especially when it comes to say medicine and therapy, is also very, demographic specific. So a medicine or a therapy which works well for Indians may not work for US, and something that works for US may not work for India. And that kind of development, that kind of research is what we are seeing. So another part of our portfolio where we invest from prop capital is in a lot of healthcare innovation. We invested in a company which is dealing with the vitiligo, the whitening of the skin problem, which is a social stigma, and that is something they are trying to solve for the Indian market. Later on, they will solve it for the global market as well. And those are the things which will come up. It requires capital, it requires a lot of patient capital, and I think that's where private equity as well as VC money is for.
Sure. I think we probably have to, we had a number of themes which I was hoping to touch upon, but we have to leave some time for Q&A as well. So just very quickly, one last theme which I wanted to touch upon, which Saurabh you had spoken about, and I'd like to get the views of some of the other panelists as well, is on the evolving role of private equity. And, historically, it's not just been about providing capital, but private equity and institutional investors have sort of driven best practices in the industry, corporate governance standards. And now we are seeing institutions go beyond that. When Saurabh, you talked about cost optimization strategies for portfolio companies who may not have the expertise. Ruchira, from your perspective, I'd like to understand how you view that, because having IFC on the cap table brings additional value to a portfolio company. So how do you see that and the role of IFC in its portfolio companies play out?
Absolutely. And so it's having IFC on the cap table, actually it's a responsibility for IFC to deliver what is expected of IFC, right? So we stand for having checked out everything on integrity, ensuring all the governance processes are in place, ensuring that ENS practices are followed and monitored regularly. So there's a lot of policy stuff that IFC puts in place when it gets into these companies. But also, given that I come in from a venture lens, so we back companies when they're fairly young, there is a lot of process controls, financial monitoring, basic stuff that gets put in place. Because many times these founders have just had, let's say, a seed round or an A round, and many things are still on Excel, not very well tracked. So we've gone in there and said, you should have a financial model. So some of the basic building blocks of process management, financial controls are put in place when we come in And so, yes, PE players have a lot of value to deliver, but I think VC investors have their own obligations and their own responsibilities because they're oftentimes going into companies where the management team may be very good technically, may have all, but they may be a bunch of coders who don't fully understand process and controls and maybe not interested as much, right? So when the first set of VC investors come in, these are the kind of questions that are raised at the board and processes are put in place and monitored. So I think both from an IFC lens and a venture investor lens, I think there's a lot of housekeeping stuff that gets put in place.
And Deepak, from your perspective of, being, a provider of patient capital, perhaps you have longer investment horizons than traditional private equity and VC players. So in that sense, you would have more deeply entrenched relationships with your portfolio companies. So how different is that role and how do you see that?
Yeah, so as you rightly mentioned, I think as a pension fund, we have pretty long-term horizon when we invest in any company. Typically, we like to invest and stay invested for 10 years, 15 years, 20 years, in some cases even more than that. And the way we look at our returns is basically on the basis of hold to maturity rather than flipping our investments in 3 or 4 years. So that way, a lot of patient capital, a lot of time that we have. Now, how do we actively try to work on improving our investments and helping our portfolio companies is that there's a lot of institutional expertise which is available because we invest globally. For example, just to tell you in road sector, we're not only a big investor in India, but we've invested big amount of money in Mexico, we invested big amount of money in US, we invested in Australia. We are right now in the process of looking at some investments in Indonesia. Right? So there's a lot of institutional experience and memory in terms of what went right in those investments, what went wrong there, what are the things that these companies should implement, what are the best practices in terms of ESG, what are the best practices in terms of technology, etc. And we typically like to impart that knowledge from one region to another region and try to do those things in other countries. Just to give you a small example on this, in India, typically on the roads that are operating there, when workers they do maintenance, you don't have a lot of safety features, barring maybe some barricading that is being done to protect those workers from falling or getting injured by incoming vehicles. But globally, there are a lot of things that road operators do. So what we've basically done in one of our roads in India, and this is the road near Delhi, it's called Eastern Peripheral Expressway, which we operate and maintain. We've brought a crash attenuators from Europe, which we placed in the work zone where workers are going to work while maintaining the road. And what happens is that when any fast-moving vehicle it comes and it goes in the direction of those workers will be working behind this crash attenuator. So that vehicle will actually first collide with the crash attenuators. It's pretty expensive instrument, and can only be used one time. So it costs a bomb, but it actually helps saving a human life. So these are the kind of things that we see, what's happening globally, where how people are giving importance to health and safety. What are the things that they are doing? We try to bring an impart to our portfolio companies. It's just an example.
All right, I think that wrap up our discussion. Do we have time? Okay. I think there's a short presentation before we move to the Q&A session.
Thank you, panelists. Before we move to our Q&A session, I would like to welcome our gold partner, Legacy Growth Managing Partner, Suraj Malik on stage to give us a short presentation on how we can set up PVC funds and family office in India and GIFT City.
Panelists are not allowed to ask me questions. All right, good morning, everyone. Can you hear me? How many guys want to set up funds, are already part of funds, want to work with funds in the room? That's why all of you all are here, right? I kind of covered the whole audience. I'm just seeing very low energy in the audience. Early morning, there's tea right after this, and I know you want to ask all these experts. We have a mix of domestic funds, multilateral funds, global funds here, and a top-notch lawyer. What I'm going to talk about is what these guys are expert at, so that's the reason I think Sonal managed to put them here on stage while I'm talking. What I'm going to cover in next 10 minutes is really how to create a fund, right? What do these guys do? How do they set up their structures? How do they invest? And stuff like that. So anyone keen on a fund setting up has to keep two things in mind. India is a land of regulations. And given that all regulations have ample amount of planning opportunities, so there's stuff to structure and there's stuff to know about, which is just regulatory. On the structuring side, the top three things that have to be borne in mind. One is the choice of the fund, right? India has three categories where now you're able to legitimately pool capital. I'll talk about, there's a nice cheat sheet I have on next time if any of y'all are thinking of doing a fund or advising on one, which fund to consider. Whether you should set it up onshore or offshore will be the second choice. It a lot depends on where your investors are, and that will signify that. And the third is, as asset managers, advisors, right? How do you make money out of this, right? It's not charity. You're going to earn money, you're going to earn fees, and how that is rightly structured, including within the people who are setting it up together, right? That whole inter-se arrangement becomes very important. These are three areas of structuring. On the regulatory side, of course, in India, SEBI is the regulator. And there are, regulations that keep evolving, but they're evolving for the better. It's a very business-friendly regulator compared to, the other financial sector regulator, which is RBI. So it helps. Taxation, fortunately, is stable for AIFs in India. There have been not too many unnecessary tweaks, and every year, every budget, you will see enough pages of the budget being devoted to, this new animal called Gift City, which means the government is really pushing hard for that to be a formidable alternative to some of the global funds. And finally, exchange control, which is, money in, money out. That's the only part RBI still governs and impacts on how funds raise capital. So this is the cheat sheet I was mentioning about. I don't know if you guys can see it well, but you'll get a copy as well. So depending on your strategy, right, are you looking at running a matched pool, which is like a PMS or like a strategy in which your investor money will be matched to specific investments, or you want to, as managers, run a pool which is blind, which is, discretionary, if I compare it to a PMS or a public market situation. That strategy will define the choice of your fund structure. It's possible to run even in an alternate, which is unlisted space, especially for early stage startups, a match pool structure under angel funds. They are meant where investors' money is mapped to each and every investee, and the returns are also mapped. There is no pooling, there's no cross-pollination of gains and losses across the portfolio. It is matched to there. These are relatively smaller funds, good structure for first-time fund managers to really build track record, good structures for investors also to commit, because other funds you need commitment of about 1 crore. Here it's 25 lakhs, but there are certain additional qualifications in India. You can't call them accredited, but some basic professional qualifications. If your investors are willing to commit more than 1 crore and your strategy is to run a blind pool, then it really depends on the investment thesis. And that's where, as I said, right, the regulator has created an entire landscape on what could you do. There is this one outer category that you see, large value funds. Again, this is meant for people who are putting or committing more than 70 crores check sizes. The regulator is saying, I don't want to regulate, okay? 70 crore, if someone is writing a check, is smart enough, and they will figure it out on their own. So very light touch regulation, rightfully so, because it's between the manager and the investor, and the regulator is saying, I don't need to do anything. Apart from that, if your strategy is to go into listed, there is a category 3 fund which is allowed to do listed, which is allowed to also do things like derivatives, F&O, which involve some amount of leverage. If the strategy is primarily to do early stage, you come back to category 1 non-angel, and if the strategy is to do unlisted, growth stage, etc., then you become a category 2 fund. This is what any structure would typically look like. Funds in India are normally set up as a trust, given that our Companies Act and our LLP Act bring with it additional compliances. In a Cat 3 situation, sometimes you could still do an LLP, but apart from that, a trust is the gold standard. About 1,100 funds exist today, and about 1,099 would be set up as trusts. So that's the simple, straightforward answer. If you ever wonder how the fund should be, because it's easier to issue units, get drawdowns, and operate as a fund. You would have heard terms like GP and LP. So GP are general partners, guys like these who manage funds. They typically sit on entities, which is an investment manager. And if someone is contributing capital, that entity is known as a sponsor. Both of them could be a single entity. You need not have separate, but you could theoretically, the law enables a sponsor to be separate from a manager. On the right-hand side are folks which are independent of people running the show. So you need an independent trustee to do this, and you need custodian in some situations now. The bar is coming down. Currently, it's more than 500 crore. The regulator wants custodians to get involved even for lower value funds. And anything that goes to SEBI, just like public offer documents go to SEBI through merchant bankers, even anything to do with AIFs today, SEBI said that I have one lens of eyes, which means merchant banker will bless everything going through them, and it just becomes faster and more efficient that way. Slightly busy slide, but just between the three categories, right, to see what is possible, what is not. Angel fund, as I said, is the smaller one. You can start or launch this fund once you have commitments of 5 crores. Okay, and in the other categories, you need commitments of at least 20 crores to do what we popularly call first close, etc. So those commitments have to be in place. And the guys running it also have to show some skin in the game. There are, again, different caps. It's 2.5% for both category 1 and category 2, but it gets capped at 50 lakhs for angel. And for category 2, it's 5 crores. This is the minimum that the manager or the sponsor has to commit to ensure that once this is in place, then you can draw down the LP money. For category 3, it's higher, but again, look at the percentages compared to the fund size. So it's not that 5 crores, if you're doing a 20 crores fund, 2.5% will be off the 20 crores and not 5 crores. And you can invest this, there are some concentration norms, etc. So that a fund runs like a fund. There are norms which says in category 2, you can't, and 1 and 2, you can't go more than 25% in one entity. And for category 3, it's 10%, just to ensure that it's more diversified. So this is largely about domestic. And as I said, right, I'm happy to take more questions. So is the panel here. We can address those. GIFT, as I said, is the new kid on the block. A lot of funds are there. I don't know, some of you already would have funds in the GIFT city. This is meant to be an alternate to doing a fund offshore. Okay, it is meant to say that what people were doing in Mauritius, Cayman, Singapore, rather do it within India and sort of build that whole ecosystem here, because there are not too many options. We heard so much about India, macro, etc. Even from a fund option within Asia, now India is emerging as a fully enabled ecosystem for people to say that fine, we can also set shop here. There are great asset managers, there are great opportunities, and the law is globally aligned. That is what they've done. So the beauty of GIFT is there is one regulator instead of multiple regulators who's deciding everything, who's figuring out, who's giving approvals, and is very, very active. It's a developmental regulator, which means they're indulging with the ecosystem players to ensure that this blueprint really becomes something live. I don't know if you visited there. It's worth visiting to see the kind of action that's helping there. Again, very strong backing by the government. And to incentivize people to come to India, anything we did, right, when we had SEZ, when we were manufacturing, we had exports, we had to give tax incentives. People otherwise don't very easily get attracted to India. So here also the government has started by saying for 10 years, out of a choice of 15, they will not tax funds, and they will also not have issues such as GST on management fees. So that's fairly lucrative for folks to come and do this here. Unlike the domestic, the structure is also far more simpler in the GIFT city. The regulator here is not regulating the fund, but is regulating the manager. And once you're a regulated manager, you're an authorized, fund manager entity. The manager can keep launching schemes, keep launching variants of funds, etc., which are merely pooling entities. So that becomes, as I said, far more aligned to how things are done in the Singapore or the global parts of the world. My last two slides before we go up to Q&A, in interest of time, is a lot of families today also, people have sold businesses, there is capital sitting in family, there's private capital, and that capital is finding direction to go global. Historically, RBI wasn't very keen to allow private money to just go into financial investments overseas, and there is still a little bit of friction there, the law and in practice. Just to encourage and enable that money to, at least even if it's going out of the country, goes through the GIFT City route, there is a regime to create a family investment fund in the GIFT City. This is meant for families using their prop capital essentially. This is not a fund that you can go and raise or market or send to third parties. So The money all has to come from entities that is owned by a single family or single lineage. Even there it is possible, and some of us would like to be professional managers to such families, it is possible to be engaged. The family can share economic interest. That's what the regulation allows, that up to 20%, which is the sort of industry standard, and 80-20. Economic interest can be shared with managers, employees, or within the family if someone is more active. But the ownership, the fund has to all come from one family. And because it is prop capital, the regulator is saying, it's sort of self-regulated or self-managed. You don't need an independent, set of regulations or compliances here. The family can manage its own affairs. You just need an independent trustee. The important milestone, again, to ensure that only the genuine guys get, and there are about 60, 70 applications, 1 or 2 have got in principle approvals. The whole regime is doing. But the important thing to note here is that it is for families who can commit to get to 10 million in 3 years. Okay, so it's not for smaller families. They're looking at serious players coming in and setting shop here. And also to encourage GIFT City, the requirement is that the principal officer of this fund should be based physically in the GIFT City. Just other SEZ or other requirements that the regulations had. So here, because it's prop money, just like I said for large value funds, there are no restrictions, there's no net worth, there's no restriction on leverage. Just saying, family, it's your money, democratic country, do whatever you want to do with it. Why it is going currently a little bit slow practically is because, while these funds can invest anywhere offshore, RBI is a little hesitant again to allow them to invest in things like real estate or allow them to, indulge in some of the financial service activities which they believe is still in their sphere of regulation and control. So those things are being eased out. And hopefully, I think by this budget and, the next few years to come, a lot of managers will start managing money which is private capital in India for global investments. That's sort of a quick 10-minute crash course on how do you set up a fund and how do you sort of structure this. Happy to open up to questions, including to the panel and from the last session as well.
Thank you, Suraj. We would take now questions if there is anything specific that you would like to ask Suraj about the presentation, and then move to the Q&A for the panel.
Hi sir, thanks for the presentation. And just one thing that which I need to understand for setting up an SME fund, okay, which will be like which we are targeting, okay. So the minimum capital that what you mentioned is about 5 crore for a Cat 1 fund. The SME funds will be falls into the Cat 1 category, right? So in that way, so the trust or maybe the investment manager has to bring in the 5 crores, or else it also says that the foreign category 1 and 2 funds, such interest must not be less than 2.5% or the corpus of 5 crores, whichever is lesser. It means that for an under core fund which we will be targeting, so 2.5 crores is the capital that which we need to bring in, right?
Yes.
Or else it's 5 crore.
So for 100 crores, it's 2.5 crores. For a category 2 fund.
Category 1 fund.
Category 1 also. So it will category 1 angel, if you do 100, then it's still 50 lakhs.
Okay, I mean for the SME fund that which we are targeting, which we are planning to.
2.5 crores is your minimum commitment. It has to come in proportion to whenever you draw the LP money. You have to sort of in priority before the LP money hits the bank, the manager sponsor money should hit the bank.
The minimum capital that which they refer is about the capital that which we are collecting from LPs, right?
Minimum capital is the capital that you as sponsor or manager would bring in.
That has to be 5 crores.
No, that is, as I said, it's 2.5% or 5 crores, whichever is lower.
Got it. Thanks.
So for 100 crore is 2.5 crores, for 200 crores, 5 crores, for 1,000 crores also it's 5 crores. That's the minimum that you need to do.
Thanks.
Any other questions specific to Suraj? Okay, we can go for the panel Q&A. Thank you, Suraj.
Any questions to the panel?
Questions to the panel? Yeah.
Hello, good morning. First of all, it was a very insightful discussion. I'll just introduce myself. So my name is Dishant Mahajan. I'm from ProS Advisors. So we are agri-infrastructure focused firm providing both strategic as well as financial advisory to the clients in India. So my question to Ruchi ma'am. Ma'am, there has been a lot of discussion talking about how India is a bright spot in these overall global situation, and we have talked that there are sectors like healthcare as well as manufacturing where a lot of innovation is happening, and of course there are a lot of investment opportunities. However, I would like to know your view, agri space, which is one of the, 1/5 of the GDP of India. So what do you see in terms of the opportunities for the PE or VC or, IFC itself?
Yes, so agri is a very important sector, also a sector of focus for IFC. And we have been looking for innovations in agri-tech for the last decade. And I must say earlier in the decade, there weren't as many disruptive opportunities. We were seeing some very basic models, but that's evolved now. There are a lot of supply chain digitization solutions that are coming into place, platforms that connect farmers for procurement of seeds and their inputs, platforms that allow farmers to connect to markets. There are technologies that are helping improve soil health. So I think there is a lot more science-led digital innovation that we're seeing in agri. There was a time when some of these assets didn't get adequately capitalized, and therefore that slowed their growth. I'm seeing a flow of capital to agri as well now. So I think the time has come, and we will see more and more of this innovation being supported by capital.
Hello, I'm Pundrikaksh from AZBN Partners. I just had two questions for the whole panel. We spoke a lot about digital infrastructure in India, and we've solved payments. We're trying to solve credit as well as e-commerce. So as the VC panel, what is the next digital infrastructure that we really need to crack down and lock in on? And second, when it comes to manufacturing, when we're talking about PLIs, is the scope out better for companies which are now being procurement platforms? Or is it better to actually just lock down and gear down on improving manufacturing capacities only? So both those questions, please. Thank you.
Maybe I'll take up the first part where the next digital initiative will be, or what we should watch out for. I think government has been very proactive in terms of digitization in all aspects. You said it right? Payments is already covered, and in fact we have become leaders from a global perspective in that manner. Lending through OCEN, e-commerce through ONDC, and the fourth one will be the digital health ID. I think that is a very big space. It is emerging. It's a very complex space. If that is something which the government is able to crack, and I'm pretty sure the way they're working towards it, it will happen. I think it can be a game changer. It will touch the lives of pretty much everybody in the country, as well as make things easier for insurance, for underwriting, for pharma companies, for data collection in terms of analytics, for phased clinical trials, etc. So I think things can become a lot more easier, and that is probably the next big thing in my view. The second thing on the manufacturing bit, if I understand your question correctly, you're saying that should one focus only on manufacturing capacity or on procurement? I think they go hand in hand. So there's one thing that is happening is that while manufacturing and assembly is happening here, there are a lot of raw materials which India still doesn't have, and those are very crucial. Certain parts of your phones, certain parts of your cars, certain parts of, for example, solar panels, they are manufactured outside India, and you have to procure that. I think once the capacity is big enough in terms of manufacturing, the procurement will become much easier. And in fact, the procurement itself will start getting replaced with manufacturing of that element itself within India, and will start feeding into the manufacturing of the main component. If any other panelist wants to contribute.
Yeah, just on the first point, I think, and you had touched upon insurance in general as a sector. That seems to be something that is likely to pick up, insurance, tech, but even devoid of the tech, insurance in general. I think the regulators have sort of realized that this is, India is not really, the penetration levels for insurance are very low. And there is a need for a lot of capital in that sector. So there have been easing of regulations in the insurance sector recently. Things which make it easier for private equity participation, simple things like, changing the definition of promoters, picking up a stake between 10 to 25%. Anything above 10% earlier, you could have been categorized as a promoter. But now there is scope for private equity participation of a larger scale in insurance companies. There is also, they've also tried to make it easier for capital extraction from insurance companies, as well as coming up with new concepts like captive insurance. So that is definitely a sector which I think if we will see some action in.
Yeah, just one question to all the panelists. I can say myself, Rajesh Thakkar. I am working like an independent director. And I have observed that many industries, capitals, are providing the capitals to the companies, startup, SMEs, but they don't insist to appoint the independent directors for the better growth and governance. I know SEBI has some guideline for the listed companies, but I think so, if you people can insist to the company where you are investing, right, then definitely it can boost up the better growth and governance. What is your opinion?
I mean, from our perspective at ChrysCapital, we definitely focus on board augmentation and having independent directors. I think that's a critical part to professionalizing the company. It's a critical part to getting a company ready to go public, to be more accountable, and honestly to just bring in an external opinion, right? And I think our focus is to have our promoters and companies just be open to changing their mind when presented with data. And I think independent directors play a critical role in that. So that's something definitely that we focus on, and we think that's a key part of the value that we bring to a company. And entrepreneur has to be open to outside expertise, and they can't think that they know it themselves, right? So that's a key test that we also perform when we are thinking about investing in a company.
Yeah, means if you can appoint the independent director, then definitely your investment will be quite safer, I can say.
Yeah, I would concur with that. We also help founding teams out by helping identify the right expertise, because oftentimes you can put a lot of thought into what domain expertise you need on the board. Some may already be covered amongst the investor directors that are present, but if we feel there's a gap, we often go out and tap into our networks to identify the right skill set and the right person to bring onto the board. So yes, we concur that can add a lot of value, and we help our companies to get there.
I think likewise for us as well. Whenever we make any investments in any companies, even though there may not be any requirement to put in independent directors, but as a best practice, we always encourage a neutral person who brings in a fresh perspective, who is not conflicted, to be on our boards, be it unlisted companies, be it unlisted companies. But some general practice that we always encourage.
I think even from the target company's perspective, it sort of increases their value in the market to have an outside person looking in, whether it's consultants, independent directors. When you have the right people behind you, that sort of is a better sell to investors. So I think that is, in general, at least the serious businesses are looking at that quite closely, and it's obviously driven by the investors, but even the target companies are seeing the importance of having those systems in place.
Yeah, hi, good afternoon all. This is Piyush Agrawal, and I am from Executive Education sector. Surprising to see nobody talked about education as a sector We had EdTech as the flavor 2 years back in the COVID. So what's your view on education, EdTech, from a private equity perspective? What could be the emerging areas which could bring in investments in the sector? Thank you.
I think HDFC Credila is one classic example of where education led financial services is something which is can be of interest, and similar such companies are there. I think the EdTech part is still evolving. And maybe from a private equity perspective versus a VC perspective, it will fall more in the VC bucket. There was a special need during COVID times when children had to be online and attend classes. And now when they are in school in a full-fledged manner and then coming back and going for various other activities, that entire perspective on having an additional EdTech provider to you is kind of reducing, and that is what most of the EdTech companies are facing as a challenge, and we are hearing a lot about it. But I think the maturity of the sector would probably, it's not yet there for private equity, more for VC. Maybe Ruchira can add to it.
Yes, absolutely. And I think, the low-hanging fruit or the initial innovation that you saw were platforms for K-12, platforms for higher education, and those have already scaled quite a bit now. But where we are seeing newer opportunities is either for the very young population set, so pre-kindergarten, etc. You're seeing a lot of engagement toys that are sort of teaching in more innovative ways. We've seen a few of those solutions. Unfortunately, they didn't scale very well. So one has to think about, what would it take for that segment to scale. The other areas where we are seeing new emerging models is, for example, in the test prep domain, the initial opportunities were around the standard competitive exams for the IITs and medicine, etc. We're seeing a lot more models around army and, military service preparation, which go into tier 2, tier 3 India and tie back to skilling and job creation because they are preparing those people for those jobs. So we are seeing newer models. Ultimately, they'll have to be supported by capital and commercial pathways where scale is seen for capital to keep flowing. But I don't think I know it wasn't mentioned earlier, but it's certainly not a sector we should be ignoring. And you will see innovation in that space.
Thank you so much for the questions. Now I would request the panelists to quickly stand up for a group photo, and then we would go for a networking break and be back at 12 o'clock for our next session, which is going to focus on sectors that are currently covering a range of investors who are going to talk about them and are keen to invest in. Thank you so much.
Thank you.
We'll be back at 12. Thank you.